We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. In the Hollywood movie Apollo 13, Command and Control asked the astronauts on Apollo 13 to stir the oxygen tanks. Kevin Bacon stirred the oxygen tanks. There was an explosion and the oxygen ran out into space. And then Tom Hanks called back and said, "Houston, we have a problem." And the following, obviously, the crisis and the problem solving followed. Now, the reason why this movie's so very relative to the bond market is that, like oxygen, bond market and the price of money is the air that breathes into the stock market and other asset prices. And if you've got a leak, you've got a problem. And in this movie, it was all about stopping the leak and getting back to Earth safely. What will they do with the bond market to save that? Because it leaks, if it goes higher, cost of money goes up, all asset prices are in deep trouble. Now, information for this video will be on the blog post. Let's go on further. Now here we have the US 10-year interest rate, not the bond, this is the interest rate. Down on the right hand side of the scale we have got the interest rate. Now, we are followers of Wyckoff, and that means we like to study the demand and supply. And this, as you can see, this pattern's been brewing for 9 to 10 years. We've had our preliminary supply here, some sort of end of the trend here, an automatic reaction. I can't really call that a sudden climax because there's no volume. Here's an automatic reaction, and now we've got a spring. But what's most important, we've got very strong strength up to resistance, an LPS, a springboard, a breakout above resistance, or one level of resistance, and now we're breaking higher. The most important thing about this, everyone can see this. Everyone can see the pressure building up. They know it's coming. So all the asset building and all the price building up there is the trend they've enjoyed, knowing that this hungry shark is circling the wounded asset prices. So everyone knows this coming, so everyone with large positions can adjust their portfolios as to when it happens. Right? So the big market players know it's coming. They can adjust their portfolios, their very large portfolios, to see it's coming. What that basically means is the waves you see here are replicated in other markets for preparation of a breakout. Now, the most important point about this structure here, they're not kidding. This stuff is real. This market here is moving. This is strong demand. Let me explain. Here we have a point and figure chart of the US bond. This market was the interest rate, because the interest rate's down the side, 1, 2, 3, 4%. This market here is the bond. Now, the thing about the bond price, I've inverted it. I've turned it upside down. Normally interest rate goes up, bonds go down. I've just turned the bond market up so the bond market shape mirrors the interest rate. Now, the bond market has volume. And as you can see, the upswing in these volume bars here are very high. Massive demand coming in. This is demand coming off a low. Okay? This is the lowest point it's been since... actually, that was lower than World War II. So everyone thought when Japan was going to invade California, that was a low point in the bonds. But this point here was lower than that. That's how artificial it was. So now we've got people buying back their bonds, okay? Because they know higher issuance of the bond market is going to be at a higher rate. And let's go back to this. There's massive issuance of bonds coming. They're talking about 1 trillion to 1.2 trillion. If a recession, 1.5, 1.6 trillion of bonds issuance. Who's going to buy that? And what rate are they going to pay? Well, they're not going to pay 2.5%, are they? They're going to pay a bit higher. So the massive demand bonds coming really threatens interest rates getting to 3.5. Mr. Larry Kudlow of the Trump administration expects 3.5. But that's probably on the minimum scale. 4% is probably most likely. The energy is there to get to 4%, or to test it at least. Look at this massive volume. Okay, this volume break up here based on this point and figure chart of half a point to 3 is the largest volume in 2 upswings ever recorded. Now we know this is futures contracts, so therefore more contracts have been written. So therefore there's a lot of energy, and quite frankly the front running in the bond market, I would say the trend, this could easily get up to 4%. Yep, Houston, we do have a problem. Now here's the other chart. Here we have the NYSE, which is about 1,800 stocks. Now, as you know, I'd like to point out that because there's 1,800 stocks in the NYSE, there's actually about 3,000 or 4,000, 5,000 ETFs. So if you've got a small sample of stocks and a multiple amount of ETFs, combining those small sample of stocks, i.e. the world of passive investing, that is too many ETFs feeding off a small number of stocks. So when the selling an ETF ever gets going, the underlying is just not there to cover that selling. So the question is, will the Fed sacrifice the stock market rally or stock market asset prices to defend the bond market? What that basically means is you force money out of stocks into bonds. Now all the pensions in America, we're talking about, everyone's talked about a pension crisis. Pensions need at least 7%, or they've promised 7% return to look after the people who are retiring. Now they haven't been able to earn 4 or 5% interest rates in their bonds because bonds have been at 2 or 3%. The Fed and central banks have crushed bonds around the world. If the bond and interest rate had stayed around 4 or 5%, pension funds would have been able to invest in bonds and earn a good interest rate to pay their members. The major mistake of a lower bond, forcing interest rates down to 0, is that money moves from the bond market into the stock market because you've got a dividend at 2.5% and you've got rising asset prices. If the bond market goes up to 3, 3.5%, 4%, the pensions and the institutions have to move money out of stocks into bonds. It's flipping crazy that interest rates even went down below 3 or 4%. It's just a madness. Anyway, this is what they've done. As an investor out there, this is a sea change if it gets going. Which market is most important? It's the bond market. The bond market in the US ricochets around to all the sovereign markets in the world. Every market, especially Anglo-Saxon markets, will suffer on rising interest rates in America. The money has to go somewhere, and the biggest bond market in the world is the United States. So yes, I think the Fed will sacrifice asset prices. In short, it's the great con. Interest rates pushed down to 0 only stimulated asset prices. It didn't stimulate Main Street, it only stimulated Wall Street. It created the massive boom of the stock market. And quite frankly, you can have a healthy economy at interest rates of 3 or 4%, and who cares about the stock market? The stock market just would have wandered around at 9 or 10,000, and only the good companies would survive. Because if you have interest rates of 4 or 5%, that means stupid money does not go into stupid companies, and it creates a healthy asset market. Suppressing money markets has allowed the boom into asset prices, and those who can feed off it and get wealthier from it has allowed this to happen. Now, for anybody out there who's middle income or less, now is to realise that what's happening now, if this continues, is a transfer of wealth from the asset prices of the stock market probably to the bond market. Because the bond market, with asset prices go up here, that means all these bonds sold prior are losing capital value. Alright? If this creeps up to 3 or 4%, all these bonds purchased by institutions and around the world are losing money on their capital value. Not losing on income, because here they're getting paid 1 or 2%, and Now they're getting paid 3.5%, and with the large deficits coming up, the value of these bonds are worth less. Not worth less, but worth less in value. So therefore they sell those back to the market. So this rally is self-fulfilling. You know, the selling back in the market, new issuance. It could be one of the most dramatic bond market routes of the last 50, 60, 70, even 100 years. So this is the sort of talk you have in the breakout. So we have the Fed will probably want to transfer money into there to try and suppress it. Now, knowing this, knowing how serious the bond market is, and what could happen if this accelerates, especially when it gets to 3.25 or 4%, do you really think the gold market collapse from 1300 on the GLD down to 1110 is real? I believe this is an accumulation wave, this most recent down wave. They've pushed gold down. They'll give the impression that everything's all right with higher interest rates, and as you know, gold can actually go up with higher interest rates, even with a higher US dollar, as people gain collateral. Because as you know, asset prices are backed with debt at a price, and if prices go up, the asset prices as collateral is not so good anymore. So therefore, if you're able to accumulate gold, which has no third-party liabilities, is a protection of wealth. So watch the gold market while interest rates climb and asset prices begin to roll over. I don't believe asset prices are going to go down in the crash. I believe they might take 6 months to a year to roll over like 2000. But who knows how things roll over. Just bear in mind that the market is different this time, because the cause and the pattern here is probably one of the best Wyckoff patterns you've seen in the last many years. And if you're an Elliott wave chap, this could be the impulse wave, this is the wave 2, or this is a massive ABC, and there's more to go. So all you can do is watch and wait, but we have to say, Houston, we have a problem, and this is very, 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 very real. Thanks for watching.